It's 10 o'clock on Tuesday morning, that's UK time. This is Roger Hirst for Refinitiv with a flash update. So yesterday we got the Bazooka from the Central Bank of the US, the Federal Reserve, and they came out with something quite phenomenal. They basically said, look, we're going to do open-ended QE. We're basically going to pump liquidity into the market from all angles. And part of the reason behind this is that they did QE. They announced QE at 700 billion. That was 500 treasuries, 200 mortgage-backed securities. That was about a week and a half ago. Half of it was taken up in the first week, clearly not enough. And the market still continued to roll over, still continued to decline. So they come out with something exceptional, even by the standards of 2008 and by any standards since then. This is quite a phenomenal injection of money. And they've got a whole bunch of facilities, these multi-lettered facilities we used to get in 2008. Here's a few of them. There's the primary market corporate credit facility. There's the term asset-backed securities loan facility, expanded money market mutual fund liquidity facility, and the commercial paper funding facility, which will be buying municipal bonds. Now, I think the key thing here is that they are doing the monetary side, and there's going to be the fiscal side coming from the government. That's still going through government. And this is happening the world over. And these are going to be vast amounts of credit put into the market, liquidity put into the market. Currently, the Fed is targeting the larger businesses because they're the ones who can tap their window and their funding windows. But the fiscal side will also look to try and get into the real economy as well. But at the same time, what we're seeing here is that the actual production lines, the supply lines, the mining facilities, they're all being put into mothball. They're being mothballed. So the supply is still coming out of the system. Workers are not being allowed back out. In fact, as of yesterday, everyone in the UK is now in lockdown for at least 3 weeks. But at the same time, you're going to increase the potential for demand. Now, clearly, demand is not going to pick up to former levels because at the moment we're dealing with this massive collapse in demand. But if you stop in liquidity whilst crunching supply, then there is a risk that you get much higher inflation. And in some ways, this is the big change that we're now seeing from central banks. Is before this year, they're always trying to suppress volatility. Well, that genie is out of the bottle. Volatility is higher. Volatility is probably higher for longer now because what they're looking at is what is inflationary, fiscal and monetary here. Now, what does that mean for equity markets? Well, equity markets have been looking to try and find a bottom. Maybe it's a short-term bottom over the last few days. We talked about this into expiry last week. Today, they're up on the back of this. It took a while. It took a while to digest it yesterday. Market still tested the lows post-expiry, and it might be a short-lived bounce. In fact, a basic bounce of a 38% Fibonacci retracement on the E-mini future would take it to 2640, and as I'm making this, it's at 2330. So we haven't really had anything of a bounce yet. And I still believe the lows are ahead of us as the real economy shuts down over the next few weeks. As I say, this is the first stage, but what we're seeing from the Fed is quite dramatic. They will be capping the yield curve, which means they will want to cap long-term yields. And that means that we could see inflation getting rampant relative to yields, i.e. yields should underperform inflation. If that's the case, then you're going to see these real yields going down, which is very good for gold. Gold should go up. There's clearly still some margin issues around gold as people have been jockeying to take some of their profits to pay for losses. But the longer term implications of this, even though the overall market framework is deflationary, this is one in which it looks like central banks will create some form of inflation, or at least a disparity between yields and inflation. So we should look for equity markets to respond a little bit more, but I think that's a bounce that you want to sell into. We should look for that real yield to move in favor of gold, and I think that's one of the key things out of this. But also volatility is probably something that's here to stay, not just in the short term, but the new framework will not be a minimum vol framework that we've seen in the past. Those are things we're looking at, see how it plays out, but this is a very, very big change on behalf of the US Federal Reserve.